Here's the truth nobody tells you. Running out of money isn't about how much you earn. It's about how much you keep, how you allocate what you keep, and how consistently you let your decisions compound over time. What you'll get in the next half hour is a complete, Buffett-inspired system to dramatically reduce the chance you'll ever run out of money again. No system can promise absolute guarantees. This is a disciplined framework based on long-term compounding, margin of safety thinking, and behavior design. Follow it consistently, and you'll change the odds in your favor. Start with a tiny math demonstration that explains the psychology behind the system. If you improve just 1% every single day, the math isn't subtle. 1.01 raised to the power of 365 equals roughly 37.8. In plain terms, small, steady improvements stack into radical change. That's not magic. That's simple compounding applied to habits, expenses, and savings. Think of your money the same way. A small, disciplined action repeated daily, tracking spending, transferring a small portion of every paycheck, saying no to a recurring impulse, multiplies into financial resilience. This video is built as a step-by-step playbook. I'm speaking as someone who's used these exact rules to move from inconsistent cash flow to predictable financial margin. I won't pretend every day is easy. Discipline is uncomfortable at first, but what's uncomfortable now prevents far worse discomfort later. If you want the worksheet that walks you through the first 30 days of tracking, the downloadable expense tracker is linked in the description. Grab it now and start the audit today. Why do people actually run out of money? The reason isn't always low income. More often, it's invisible bleeding, dozens of small, repeated drains that quietly eat your cash and your options. It's the delivery fees added without thinking, the subscription you forgot to cancel, the repeated impulse buys justified by "I deserve it." Behavioral traps are at the heart of most financial failure. Humans are wired for immediate satisfaction, but money rewards delayed, consistent choices. Confusing income with financial security is the core error. Money that arrives must be kept, allocated, and invested wisely, so it can work for you later. Beyond behavior, there's poor allocation. People concentrate on income growth without a plan for retention and deployment. They treat money like candy to be consumed now, rather than workers to be put to work. Without allocation rules, one emergency, one job change, or one medical bill can flip everything. The system I'll walk you through addresses 3 levers at once. Stop the bleeding, create margins, and put capital to work. Each step gives you exact actions to take immediately and small exercises to build momentum. Step 1. Track everything for 30 days. You can't fix what you don't measure. The first step is surgical clarity. Record every single dollar you spend for 30 straight days. That includes coffee, tips, delivery fees, subscriptions, gifts, one-off purchases, everything. The goal is not shame, it's information. Most people are shocked to see the pattern of small recurring expenses adding up to hundreds of dollars each month. Why it matters. Measurement reveals patterns and excuses. When you see your cash flows in black and white, you stop rationalizing. A 30-day audit exposes categories you can immediately trim and behaviors you can design around. It also builds momentum. Knowing where your money goes is the foundation for every later step. Bucket allocation, debt payoff, automation. How to do this? Exactly. Use one central method you'll actually maintain. The downloadable 30-day expense tracker is an ideal start. Put a note app on your phone and record every purchase as it happens. If you prefer paper, carry a small notebook and jot every transaction. At the end of each day, categorize those transactions into simple groups: essentials, subscriptions, transport, food, discretionary, and one-time. Don't try to be perfect. Consistency matters more than precision in this first month. Micro-task for the next 24 hours. From the moment you finish this video, commit to recording every purchase today. At the end of the day, review and categorize those entries. That single exercise creates the awareness you'll need to change behavior. Example, and simple math. Imagine you discover you spend $4.50 a day on a delivery app. That's $4.50 times $30 equals $135 per month, or about $1,620 per year. It's just one small habit. When repeated across 5 or 6 similar habits, the bleeding becomes a hole. The audit shows where to plug it. Step 2, 3 buckets. Plus, pay yourself. First, once you know where the money goes, give every dollar a job before it arrives. Use a simple 3-bucket allocation: survival, future, and quality of life. A practical split to start with is 50% for survival, essential expenses, 20% for future, savings and investments, and 30% for quality of life, discretionary spending. The exact percentages can be adjusted to your circumstances, but the discipline of pay yourself first must be non-negotiable. Why it matters. Giving money a job removes the argument in the moment of temptation. When you allocate automatically, you treat savings as a fixed cost, not a leftover. This mirrors a core Buffett-style discipline. Prioritize long-term capacity before short-term gratification. How to implement. Decide your percentages and automate them. On payday, set up automatic transfers. 50% to your checking for bills and living expenses, 20% to savings, investment accounts, and 30% to a spending account for treats and lifestyle. If you can't immediately hit 20% for future, start smaller. Even 5 or 10% is progress. And increase by 1% each month. Use separate accounts so the future bucket isn't accidentally spent. Micro-task for the next week. Set up at least one automatic transfer that occurs on payday. Start with 10% if 20% feels impossible, then schedule a plan to raise it gradually over the next 90 days. Example, if your net paycheck is $3,000, under the 50-20-30 rule, you'd allocate $1,500 to survival, $600 to future, and $900 to quality of life. That $600 per month, invested over decades, becomes the engine of compounding. Step 3. Attack high-interest debt first. High-interest debt is a silent tax on your financial life. Credit cards, payday loans, and overdrafts typically carry rates that destroy your compounding ability. Imagine pouring 20% interest into a bucket every year. That's money you'll never get back. Why it matters. The interest expense on high-rate debt often dwarfs the returns you can reasonably expect from new investments, especially net of taxes and risk. Eliminating that debt restores your ability to invest productively. How to do it? List all debts with the outstanding balance, APR, and minimum payment. Rank them by APR from highest to lowest. Use the debt avalanche. Pay the minimum on all accounts. Then direct every extra dollar to the highest APR balance. If avalanche feels demotivating, the debt snowball, paying the smallest balance first, can give psychological wins. Either method works if it accelerates payoff. Micro task this week. Create a debt list with balances and APRs. Make a plan to redirect any small windfalls, tax refund, side gig income, gift, to the highest interest account. Quick math illustration. Say you have a $5,000 credit card balance at 20% APR. That's roughly $1,000 per year in interest if the balance were static. If you instead put $5,000 into a taxable investment expected to average 7% annually, you'd earn $350 before taxes in the first year. The gap, about $650, is interest you're paying to lenders rather than letting money work for you. Prioritize paying the lender when rates are that high. Step 4. Build a 6-month emergency fund in liquid accounts. Once high-interest debt is manageable, your next priority is a robust emergency fund. Aim for roughly 6 months of essential expenses held in liquid, low-risk places where you can access the cash quickly. This isn't an investment designed to beat inflation. It's insurance, so a job loss, medical bill, or major car repair doesn't force catastrophic decisions. Why it matters. Without sufficient liquid reserves, people sell investments at the worst moments or borrow at high rates. Your emergency fund is the margin of safety that gives you time and options. 3 things Buffett and many resilient investors value highly. How to do it step by step. Calculate your essential monthly expenses realistically. Housing, utilities, groceries, insurance, minimum debt payments, health care, and reliable transportation costs. Multiply that by 6 to get your target. Use a separate high-yield savings account or money market with quick access. If 6 months is impossible at first, target 1 month, then 3, then 6. The key is consistent contributions. Microtask this week. Calculate your essential monthly expenses and set the 6-month target. If you can save $100 per paycheck, set a standing transfer to your emergency account. Example timeline. If your essentials are $2,500 per month, your target is $15,000. Saving $500 per month gets you there in 30 months. Raising your savings rate by trimming small expenses or increasing income shortens that timeline. Step 5. Assets versus liabilities. Buy things that put money in your pocket. A simple mental model. Assets put money into your pocket. Liabilities take money out. This is a behavioral distinction more than an accounting quibble. A rental property, dividend-paying fund, or business that generates net positive income is an asset. A brand new car that costs premium payments, insurance, and rapid depreciation is a liability. Why it matters. Accumulating more assets that generate cash flow reduces reliance on a paycheck. Over time, asset-generated income creates a margin that protects against job loss, illness, or retirement risk. How to take action. Focus discretionary capital towards small, understandable assets first. For most people, that means boosting retirement contributions, building a taxable brokerage account with diversified holdings you understand, or investing in your business or skills that produce higher income. Avoid complex financial products you can't explain in one sentence. Micro-task for the next 30 days. If you have any left over in your future bucket, commit a fixed, small amount each month to an asset-focused account. Even $50 per month in a simple index fund grows faster than keeping that money in a checking account when properly invested for the long term. Illustration on liability versus asset math. A $30,000 car financed with a 3-year loan costs you principal, interest, insurance increases, and depreciation. Compare that to a $30,000 investment. in a diversified portfolio that, over long periods, has historically returned more than inflation and generates dividends. The difference in long-term outcomes is why choices matter. Step 6. Opportunity cost. Before every discretionary purchase. Before any discretionary purchase, ask, what else could I do with that money? Opportunity cost is the often neglected cost of choosing one thing over another. That $4,000 phone purchase is not just $4,000 today. It's what that $4,000 could become if invested. Why it matters. Our brains discount future value in favor of immediate utility. Naming the opportunity cost forces more honest trade-offs. When you measure purchases against what they could grow into, many impulsive buys lose their appeal. How to apply the rule. Create a simple wait-and-check rule for major purchases. If you plan to spend more than a threshold you set, for example $300, wait 72 hours and run a quick opportunity cost calculation. Compare the immediate pleasure of the purchase to the potential future value of investing that money for 10 years at a reasonable illustrative rate. Micro task this week. Pick one upcoming discretionary purchase. Before you buy, run the 72-hour rule and calculate what that money would look like invested for 10 years at 7% annually. Use the mental comparison to decide. Illustrative calculation, the $4,000 phone example. If you invest $4,000 at an illustrative 10% annual return for 10 years, this is an example, not a guarantee, the math is 4,000 times 1.10 to the 10th power, which equals roughly 4,000 times 2.5937, given about 10 to 375. Even at a lower illustrative rate, such as 7%, $4,000 grows to about $7,871 over 10 years. Framed this way, the price of immediate consumption is far clearer. Step 7. Increase your earning power. Invest in yourself. Your most important asset is your capacity to earn. That means skills, credentials, networks, and a reputation that commands higher pay. Too many people treat education or skill development as optional. In most careers, investing in targeted skills yields high returns. Why it matters. Boosting income multiplies everything else. An extra $200 per month saved and invested compounds far more powerfully than cutting out one latte per week forever. Income growth expands both your survival margin and the rate at which you can build assets. How to act. Identify the highest payoff skill you can learn in 3 to 12 months. This might be a professional certification, a technical skill, sales training, or learning to manage a profitable freelance business. Create a learning budget in your future bucket. Measure progress by concrete outcomes. An interview, a new client, a raise. Microtask for the next 30 days. Pick one skill that is both in demand in your field and that you can start learning immediately. Block 30 minutes daily for focus practice and list measurable milestones for the next 90 days. Example, if an extra certification can increase your salary by $5,000 per year and costs $1,000 to obtain, the payoff is immediate and tangible. Even modest percentage improvements in earnings compound your capacity to build wealth. Step 8. Build multiple income streams. Relying on a single paycheck is vulnerability, not stability. Multiple income streams, even if small, reduce risk and increase optionality. These streams can be active or passive, a side freelance gig, small rental income, revenue from a hobby, turned scalable, or royalties. Why it matters. Diversified income smooths cash flow and accelerates savings. Multiple sources increase the probability that even if one income source falters, others keep the lights on. How to start? Begin with one small, predictable side income you can build in evenings or weekends. Treat it like a business. Keep simple books, track profit margins, and reinvest profits into growth or debt repayment. Don't chase get rich quick. Build repeatable, scalable systems. Microtask for the next 90 days. Identify one side project you can realistically start with minimal upfront cost. Spend the first month validating demand, then scale in month 2 and 3 based on what works. Step 9. Automate finances to remove willpower. The fewer active financial decisions you must make, the less room for human error. Set automatic transfers, automate bill payments, and use recurring investments. Automation removes the need for daily discipline and capitalizes on inertia for your good. Why it matters? Willpower is finite. Automation uses default rules to ensure saving and investing happen before temptation. It's a simple behavioral design trick that stack ranks among the highest ROI changes you can make. How to implement? On payday, automate tax advantage contributions, 401k or IRA, to at least the employer match. Automate transfers for your future bucket into a savings or brokerage account. Automate payments for recurring bills to avoid fees and late charges. Use separate accounts for bills and personal spending to create clear mental budgets. Micro-task this week. Set at least one automatic transfer to your future account to occur on payday. If you have an employer match on retirement, ensure you're contributing enough to capture it. Step 10. Harness compound interest. Time is your ally. Compound interest is the engine of long-term wealth. The earlier you start, the more time your money has to grow, and the less you need to save later to reach the same result. Small contributions early beat large contributions later. Why it matters. The difference between starting at 25 versus 35 is enormous because of compounding. Time and consistency turn modest savings into substantial sums. How to practice? Prioritize early and consistent savings. Even small recurring contributions accumulate. Use tax-advantaged accounts when appropriate, but don't let perfect be the enemy of good. The key is regularity. Calculation example. Assume you save $600 per month into an investment that earns an illustrative 7% annual return. After 30 years, the future value using the annuity formula is about $600 times 1.07360. 1, talk a 0.07 in monthly terms. For simplicity, on an annualized basis, $7,200 per year invested at 7% grows to around $794,000 in 30 years. This example shows how reliable monthly contributions scale considerably with time. Step 11. Invest only in what you understand. Never buy financial instruments you can't explain in a sentence. Complexity often hides risk and fees. Buffett's discipline around simplicity and understanding isn't about snobbery, it's about avoiding surprises. Why it matters. Understanding reduces the likelihood of panic and bad decisions. If you can explain how something makes money, you can more rationally assess its risk when markets get volatile. How to act. Create an investment watch list of simple vehicles you understand. Diversified funds, straightforward businesses, or assets you can reasonably value. If a product or strategy requires pages of disclosure or promises unusually high returns, treat it skeptically. Microtask today. Write down in plain language why each investment you own exists in your portfolio. If you can't explain it simply, research it or consider moving to simpler holdings. Step 12. Protect your money from yourself. Behavioral defenses. The average person loses more money to their own impulses than to market fluctuations. Design frictions that make impulsive spending harder and good financial behavior easier. Small design changes have outsized effects. Why it matters. Structure your environment so good choices are the path of least resistance. That's the whole point of automation and bucket allocation. But there are additional tactics that help lock in discipline. How to apply behavioral design. Put friction between you and impulse purchases. Unsubscribe from promotional emails. Remove one-click payment information from online stores and use a separate card for discretionary spending that you don't carry physically. Create spending rules for big purchases, a waiting period, a sleep-on-it rule, and a reality check against opportunity cost. Microtask this week. Identify one impulse habit and create a friction for it. For example, delete saved card information from one online store and require entering your card details each time. Step 13. Price versus value. Buy value, not just cheap. Price. A low price is only useful if it also delivers real value. Price is what you pay now. Value is what you get over time. When evaluating purchases, ask, what's the long-term return on this choice? Why it matters. Cheap often means temporary satisfaction, while value considers durability, utility, and long-term savings. This framework should apply to everything from groceries to cars to education. How to decide. For each major purchase, run a simple value checklist. Durability, maintenance costs, resale value, and opportunity cost. Choose purchases that give you the most utility per dollar over the product's lifetime. Microtask in the next 30 days. Before your next big purchase, write down the expected life cycle cost, purchase price, maintenance, likely depreciation, and compare it to alternatives. Step 14. Anchor. Money to a purpose and surroundings. Money without purpose drains motivation. Define why financial security matters to you and anchor decisions to that purpose. Surround yourself with people who reinforce disciplined behavior and distance from environments that normalize wasteful consumption. Why it matters. Social norms shape spending. If your community values displays of status through consumption, you will be tempted to match. Purpose creates a North Star that reorients choices toward long-term gain. How to do it? Write a short financial mission statement. A sentence or two defining why you want financial security. Share goals with a trusted friend or accountability partner. Seek mentors and communities where saving and investing are normal. Microtask today. Draft a one-paragraph financial mission statement and tell one close person about it. Step 15. Treat money like employees. Put capital to work. Think of capital as workers you hire. Each dollar should either pay down destructive debt, buy an asset that returns more than inflation, or buy skills that raise your earning power. The goal is to have money generate repeatable cash flows so you don't have to trade time for every dollar. Why it matters. Treating money as employees forces an ROI mindset. You stop chasing status purchases and start building systems that produce passive or scalable returns. How to implement. For every allocation decision, ask, what is the expected return? What is the risk? How liquid is it? Favor allocations that generate or amplify income and treat discretionary spending as an expense of living, not an investment. Microtask for the next 90 days. Treat your next windfall differently. Before spending any of it, allocate proportions to debt reduction, emergency fund, and an investment first account. Case studies and calculations. Practical illustrations. Case study A. The iPhone versus invest $4,000. Opportunity cost in practice. Imagine choosing between buying a $4,000 phone now or investing that $4,000 for the next 10 years. This is not a value judgment, it's an exercise in clarity. If invested at an illustrative 10% annual return, used only as a historical style example, not a guarantee, $4,000 grows to about $10,275 after 10 years. At 7%, it grows to about $7,870. That's the opportunity cost, the difference between present consumption and future financial flexibility. Walking through the numbers makes the trade-off real. If you need that smartphone for work and it produces revenue that outweighs its cost, it may be worth it. But if the purchase is primarily for status and immediate joy, the alternative is owning substantially more optionality a decade from now. You decide which future you prefer. Case study B. Debt avalanche versus minimum payments. The cost of delay. Consider a $5,000 credit card at 20% APR. Annual interest at that rate is about $1,000 if the principal remains unchanged. If you pay only the typical minimum payment, often a low percentage of the balance, most of your payment goes to interest, and the principal disappears slowly. That means years of payments and thousands in interest lost. Now imagine applying an extra $200 per month toward that balance. Pay the minimums on other accounts, but attack the 20% debt aggressively. That extra payment reduces interest compounding and shortens payoff time dramatically. The exact math depends on payment amounts, but the principle stands. Paying extra on high-rate debt is usually the highest guaranteed return available to an individual because it saves interest immediately. Case study C, small habit, compounding into a substantial emergency fund. A modest example, skipping a $5 coffee every workday and investing the equivalent adds up. $5 per workday at 365 days approximates $1,225 per year. If you invest that amount annually and it grows at an illustrative 7% average after 30 years, you'd have around $173,000. That number is illustrative. The point is how small, consistent changes feed compounding and build real options. Implementation roadmap: 30 days, 90 days, 1 year. The 30-day plan: complete the expense audit, set up one automatic transfer to your future bucket, and create your debt list with APRs. Decide on your 3 bucket percentages and begin a small habit to track every purchase. The 90-day plan: automate all paycheck allocations, start paying extra on one high-interest debt, and build at least 1 month of your emergency fund. Begin a modest side income or enroll in a skill-building course and practice it weekly. The 1-year plan: reach 3 months of emergency savings or more, eliminate at least one high-interest debt entirely, and have a consistent automated contribution to investment accounts. Build an investment watch list of simple assets you understand and commit to regular learning about those investments. Templates and practical tools: word-based, 30-day expense tracker. Outline: for each day, note date, merchant, amount, payment method, category, essentials, subscriptions, food, transport, discretionary, and a 1-sentence note about necessity, e.g., meal with client or subscription I forgot. At the end of each week, sum categories and look for anomalies. Automatic transfer schedule. Sample: on payday, transfer a fixed percent to 3 accounts. Future: automated investment or savings. Emergency: liquid high-yield savings. And quality of life: spending account, For example, paycheck arrives, 20% auto transfer to future, 10% to emergency, until target reached. Remainder split into checking for bills and spending account for lifestyle. Debt payoff. Ranking table. List each debt with columns for balance, APR, minimum payment, and monthly interest cost. Highlight the highest APR first. Create a column for extra payment target and update balances monthly to track progress. Emergency fund target calculator, word instructions. Total your essential monthly outflows and multiply by desired months of coverage. For 1 month, 3 months, and 6 months, list amounts and plan monthly contributions needed to reach each target within a given timeline using the formula required monthly contribution. Chucker's target, current balance, TOS, months to target. Protective checklist. Before major purchase, estimated total cost, ongoing maintenance, opportunity cost over 10 years at an illustrative 7% rate, a 72-hour waiting period, and a decision justification tied to your financial mission statement. Final challenge, the 30-day commitment. Pick one step from this plan and commit to it for 30 days. If you've never tracked your expenses before, that's the single best starting point. If you're drowning in high-interest debt, commit to the debt list and attack the highest APR aggressively. If you have no automation, set up one automatic transfer on payday. The compound effect of one chosen consistent action will amaze you. One last practical illustration to bring this home. Start with $100 and improve 1% per day in a behavior that saves or earns money. That same exponential math applies to habits and finances. The small daily wins accumulate into a financial buffer that makes running out of money far less likely. If this guide helped and you want the full workbook with the 30-day tracker, templates, and the step-by-step checklist, grab the link in the description. Commit to one step now, comment which one you'll do first, and let us know your progress in 30 days. Subscribe for more practical systems that favor consistency over flash. Financial security isn't a promise I can make to anyone. It's a set of actions you can take that stack the odds in your favor. Start today and let time and discipline do the rest.